Well, we have our Fed policy announcement, and at least at first blush, it seems to leave the markets in relatively good form. Now, we don't get a big response from stocks that seems convincing, but we do get the averting of what could have been much worse, at least in the fears of the markets. And now a big question as to what comes next. That's what we're going to explore here on Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And as ever, we'll take a look at the price action. We'll take a look at what that price action seems to suggest. And then we'll, of course, go through in significant detail here exactly what the Fed did, what the Fed didn't do, and what that seems to mean going forward. So we'll start kind of with the market reaction and what that seems to mean. And then we'll go into more sort of the forward-looking bit from there, because it does seem to be a tale of two worlds here: price action versus sort of realized headway. This is what the markets did ultimately by the close of the day, and we can see here S&P liked it. Nasdaq, not so much. We had some Oracle earnings that came out after hours that didn't help matters, but Nasdaq was kind of soggy even through the Fed. We can see yields come in lower, and that's despite that the Fed was widely expected to deliver the rate cut that it delivered, and the tally going forward really doesn't seem to be supportive of what we're seeing here. But there is a bit of a caveat. The Fed saying it is looking to restart asset purchases in a very limited way, looking to buy about $40 billion at the onset in short-term paper, ostensibly not to alter the setting of policy, but to make sure that markets don't over-tighten because of a liquidity shortage going into the tax season and sort of various kind of operational and tactical things like that. But the market certainly takes notice. Crude oil a little bit higher here, but still within that same kind of blinders on drift that it's been locked in for weeks. Gold higher, dollar weaker. Bitcoin, interestingly, doesn't pick up on the risk-on flavor and the anti-dollar flavor of the day and kind of skids into the close. So what are we left here to extract just looking at the price action? Well, stocks higher, yields lower, gold higher, dollar weaker. I mean, that comports pretty clearly to a dovish interpretation of what came out. And what's interesting is that what came out wasn't very dovish. And so what this starts to look like is maybe a sense of relief that the outcome was not more hawkish than it was. What was that outcome then? Well, let's go through it here. This is the policy statement and the annotations here that are tracking the changes in statements from October into this December statement. Those are from the Wall Street Journal. Hat tip to Nick Timmeros there, who published it on the internets. And so when we look here at the changes, we can see this is not exactly the most dramatic set of changes. This is not particularly eye-catching here. There is a little bit of a change here in the third paragraph where the Fed says, in considering the extent and timing of additional adjustments, not so much in considering additional adjustments. So it seems like additional adjustments are being made more likely by this statement, whereas before, perhaps there wasn't even a commitment for adjustments. That's interesting, but very nuanced and doesn't seem particularly telling. The big change actually happens down the page here, where you get this new bit added where it says the committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term treasury securities as needed to maintain an ample supply of reserves. So for whatever reason, the Fed thinks that there is tightness in short-term money markets and is looking to paper over it. Powell said in the press conference later that this would amount to about $40 billion as an initial purchase. Now, this is not a big sum, and the Fed chair is saying that these purchases are going to run at this clip for a few months and then start tapering off, in the sense is that they'll start to taper off sometime after tax day, mid-April. So it looks like what the Fed is looking to do here is sort of paper over some sort of a liquidity crunch that it envisions. And not surprising in this context, if the Fed is going to come out here and buy short-term paper, then short-term yields are going to come in because prices are going to come up. And indeed, we see that in the 2-year here. Perhaps there is also some spill-off into the longer end. That may very well be why the dollar gets whacked to the extent that it does. Because, of course, the dollar is very sensitive to short-term borrowing costs and the relative spread between those borrowing costs and those of other currencies, which essentially come down to the idea that one person's borrowing is another person's income from lending. And so you'd want, usually, to hold the higher yielding currency, taking any two currencies and comparing them, because you could make more money lending it out. There's a greater interest return on that currency. It pays more. And so think of it almost like dividend yield. And so you have a situation then where the Fed is very clearly saying, we're going to be a buyer of short-term paper. We're not looking for that to be an object of policy, but the markets obviously understand that if there is a new buyer in size that they didn't know about, then yields should be lower, prices should be higher, and that's what we see here, at least as a first adjustment. And of course, the dollar is very sensitive to that, so perhaps that explains why the dollar's move is more convincing today than are the moves elsewhere, because though we have a rally in stocks, it does not make meaningful headway. We don't manage to take out the barriers we've had on the range in the S&P, going to the end of last week, and before that going to the middle of November, right around 6,900 or so. We don't end up clearing that barrier at 25,850 or so on Nasdaq, where we've been since the markets jeered the Fed's October 29th decision. Still within the recent range there. We don't have a breakout on gold. Again, it's higher, but still well within the range where it's been oscillating, in a very narrow range at that. Since the beginning of this month, gold has basically gone nowhere at this point this month. If we look at the net change for gold this month so far, it is, drumroll, 0.21%. So nothing is really going anywhere. So we have these responses and they seem to paint a picture, but none of them really have a breakout. But the dollar does. Euro seems to break out higher. The pound is attempting to break out higher. The Aussie breaks out higher. The Canadian dollar breaks out higher. So a weaker dollar across the board here. And that's perhaps the bigger story here, this buying of these bills and the driving down of short-term rates, this is perhaps why we get conviction there. But of course, it's also very interesting that we don't get conviction elsewhere, which tells you that there's a level of confusion as to what the Fed actually means here. Now, looking at the summary of economic projections, again, we see an upgrade of growth expectations, and for next year, a particularly emphatic one from 1.8 to 2.3%. Now, we did see GDP expectations upgraded in September also, but this is much more significant. We also get a somewhat of an adjustment in the unemployment rate in a positive direction, mostly steady here, but next year slightly lower. Inflation adjusted slightly lower for this year and next, both at the headline and the core. But then the path of rates here, absolutely unchanged. Now, of course, the bogey for us was this number. And the markets initially didn't like that we didn't get an adjustment here because we still, despite all of what we've seen already, we still have 55 basis points on the board for next year. And of course, there's another rate cut right here. But still, the Fed is saying, no, we're only going to have one. And it does, as we discussed yesterday, increasingly seem to look like a statement of intent rather than a commitment to this or that thing. Here's what Powell had to say about it on the stance of monetary policy. This is the part that the markets didn't like because they think the Fed could be more circumspect in cutting further on this basis. Powell was saying the policy rate is in a plausible range of neutral, and the committee is well positioned to determine whether further adjustments are needed. Not when, if. There's no preset path. The risks of inflation and employment are equally balanced, so the policy should sit around neutral. This is not an endorsement for more cuts. This is the Fed saying, we're going to sit here for a while. And saying a further rate cut is not our best case. So this then is where things get interesting, because initially when this comes out, the markets don't like it. They say, wait. So you're saying you're going to trim back rate cut expectations. We wanted you to go in the opposite direction. So not only are you not going to change what you're writing down for the forecast, you're going to talk us through why you're not even going to smooth that over rhetorically. You're saying, yeah, well, you really shouldn't be expecting a lot of easing. Now, on what happens with the labor market, because of course that was ostensibly the reason why we started to get all of these cuts, restarted, as it were, we get the sense that we are still in this kind of locked labor market where there's not a lot of hiring, but there's not a lot of firing. And so we get a labor market that the chair describes as less dynamic. What was perhaps the most interesting part here, and this maybe is where the Fed gets its bias, is they're looking at the overcounting error in non-farm payrolls as being about 60,000 jobs a month. And with the headline numbers then averaging around 40,000, the Fed seems to think that once you take the overcounting out of the picture, you're looking at about 20,000 jobs lost per month. And that's kind of the cadence. Now, Powell does say he does not expect a sharp downturn in employment, but he doesn't want to push down job creation with policy. And so it seems like we're still in this space where the Fed is saying backstopping the labor market is becoming an increasingly important objective. Now, we'll see what kind of data we're going to get coming in here, but even Powell cautioned that the data is probably going to be very skewed because some of the numbers were simply not collected. And so we'll see how much clarity there is there. But for now, it seems like the Fed is prepared to say, on the first side of its mandate, there is enough worry about maybe risks to the labor market to keep the bias on the side of cuts without committing to how many cuts and without committing to when they will cut. On the inflation side of things, it still looks to be somewhat elevated, but it looks like what the Fed here is saying is this is, and I'm sure Powell was carefully coached not to use the transitory word, but they're saying maybe this will be a one-time price adjustment because most of it seems to be coming from the goods side, and that's the tariffs. Whereas the part that's been the most sticky for longer, the services side, seems to be easing. And so the Fed is seemingly comfortable here. They were asked if they're okay with 3% inflation, and Powell said, no, we're not. We want to get to 2%, and we think that once we get around the horn on rebasing for these tariffs, our baseline is that we will do that because once they fall out of year-on-year calculations, which should happen at some point in the first, going into the early second quarter, we should have inflation significantly lower and back in the low twos. We'll see if that holds up. But if we take this together, then it starts to make sense why the Fed has this easing bias. On economic growth and on the risks, we can see that it's much the same song and dance. There's not a plan. There's higher uncertainty. There is a desire to move with caution and in a very deliberative way while the two goals are in tension. And what the Fed is seemingly saying here, what Powell is seemingly saying, that there's not a reason to worry about the economy, that the cuts are coming to backstop a labor market that isn't so much falling apart as it is maybe a potential risk downwind. And certainly if they're extrapolating that we're getting an average of 20,000 jobs lost every month, it's not a lot, but it nevertheless is a loss, and that's not what the Fed wants. Maximum employment, that does not make. So in that context, this SEP seems to make sense, where we get more growth. The unemployment rate is basically steady. Inflation comes down because the tariffs rebase out of the numbers, and you don't know what you need to do on rates because you're not really sure what the unemployment situation is going to look like. It was very key, and this is where sentiment seemed to turn, when the market was initially annoyed that Powell didn't move, or that the committee didn't move this point right here to something more dovish, lining up more closely with what the Fed is anticipated to do by the market, which is at least one more cut, as we can see here, than what that statement says. That statement says 1. This says 2 for next year. The comment that Powell made in response to a question where he was asked, do you think we're in the middle of a productivity boom? And that's sort of how you get the current environment. That's how you get kind of a wobbly labor market, but it's not necessarily for bad reasons. It's for transition reasons. And Powell seemed to broadly endorse that idea. He certainly cautioned that you can't really point the finger at AI for that because improvements in productivity have been going for a few years now, longer than you could really point the finger at AI and say, oh, that's the thing. But nevertheless, the story seems to be, if you have greater productivity, you're not going to get a lot of turnover in the labor market from the demand side because you can do more with less. And so if that's what's going on, then you're going to get these kinds of funky things in the labor market that maybe the Fed needs to address by rebalancing policy. And if that happens at the same time that inflation from tariffs works its way out of the headline figures calculus, well, then you have your soft landing. And that seems to be the positivity that the markets are broadly responding to here. And indeed, it is not unlike what we discussed when we were looking at this yesterday. We can see from the latest data that we do have, data outside the government's purview, the Institute for Supply Management told us that the service sector has strengthened as of December, even though we still have relatively anemic manufacturing. And so the overall economy seems relatively anchored at okay levels of growth. As ever, this is done in the logic of PMIs. 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below, the faster the contraction. So you can see here for the service sector, which accounts for the overwhelming majority of the economy, we have something of a pickup. And although it doesn't look like December was a better month than November, once you kind of weigh this out and say, okay, about 80% of the calculus here, 70 to 80%, let's call it services, and 20 to 30% is manufacturing. It looks like growth is about the same for November here as it was in October, but those 2 months also amount to the strongest sort of collective reading we'd seen since February. So the economy looks to be in okay shape, if not kind of screaming. We can see that for the most important service sector, employment is contracting, but at a slower rate. And the rate has slowed over the past several months, consecutive reports. And we see inflation is still elevated relative to history, but at least it's trending down over the past several months. Even in services, inflation ticked a little bit lower in this last edition. So when we consider all of this together, you kind of get what the Fed is trying to say here. What's interesting, again, is that the markets don't ultimately run away with this and say, oh, goody, inflation is going to come in. That'll give the Fed license to cut. The unemployment rate might well stay uncomfortable, and the labor market may well shed some more dynamism because of efficiency gains. Okay, so maybe that encourages further easing, but the economy is not in a bad way, so easing in a bad economy would be something that markets could be concerned about because the economy were weak, but that's not what this is. It seems like the Fed is not giving the markets as much easing as perhaps they want, but is biased toward easing at a time when the economy is not really hamstrung in a worrying way, or really hamstrung very much at all. In fact, if we take a look at the S&P global version of where growth is, we can see these composite index levels that take in both manufacturing and services are recovered from the kerfuffle at the beginning of the year around tariffs and are now hovering around these heady levels that were there at the end of last year. So looking at all of this together, it seems to make sense why the market ultimately liked it, but also not why they didn't like it more, and there's not a concerted sentiment response. Perhaps we are, in fact, still going to get something on reflection here over the next 24 hours. On October the 29th, it took the markets a full 24 to 48 hours to really decide that they didn't like what the Fed was putting out there. We'll see what happens from here. But so far, the big barometers of risk sentiment are somewhat relieved but circumspect. And it's really the dollar making the big move, perhaps because the Fed announced, as we said moments ago, that liquidity facility at the front end and took those yields lower. As far as exposure is concerned, I trimmed back quite a bit ahead of this Fed announcement. I took off gold, I took off silver, and now I've started to peel away this dollar exposure that clearly didn't work here. Euro seemed to break out, so I took that off. Pound did not, so I still have that on. Still have a tiny bit on the short side of Bitcoin, which again did not join stocks here in whatever positive response. Still have a little bit in SPY risk-off exposure via this put vertical because, again, the breakdown or the breakout, rather, did not occur. Still have a little bit of crude oil, which continues to grind. A bunch of put verticals there. It's been very slow going, though, as we've talked about. And so I'll be looking to manage this very soon here. But otherwise, I've really left things to the longer term positions like EWZ, which looks well into next year, and MSOS, which looks well into the end of next year and the beginning of 2027. So I've backed up a little bit here as far as my exposure, and I'm looking for what we get. There should be a settling of the dust and some decisions getting made over the next day or two, and I'll be watching very closely to reinitiate new exposure and maybe to flip some things around. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, looking at the Wall Street close and where things might go therefrom. Also writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.